Let's move on to another conversation then. We have Signature Global on our radar. The company has reported a steady first quarter business update. Sales and volume have declined year on year, but risen sequentially, while realizations have improved by about 33%. Let's discuss the business momentum and growth outlook. Rajat Kathuria, who is the CEO, joins in now. Quarter on quarter, there's been a big jump, 63% to be precise, but year on year, it's down 15%. Even the area which has been sold is lower, both year on year as well as quarter on quarter. You did have some sales from premium projects. This decline year on year, is it largely because of base effect? Or do you think that there is something underlying which has shifted a little bit in the real estate space?
No, you're right with the former understanding that it's largely because of the base effect. So last year, while we achieved about 10,300 crores of sales, the first quarter was the best quarter in terms of pre-sales for us, where we did about 3,100 odd crores. So we were competing against, the best performing quarter of the previous year. But in general, I think we had a fairly steady show. The last 3 months, we recently, just in the month of June, launched our first, new project for the year by the name of Cloverdale. This is in Sector 71, Gurugram, which is on the southern peripheral road and one of the key micro markets for us. And within a span of less than a month, we've seen a fairly robust sort of response to it. And we are, quite, happy, and, it's a good validation that, these new launches are seeing a good uptake in the market. So from our perspective, it's a good sort of, quarter where we've achieved more than 20% of the annual target.
Last year, the entire year was front-loaded with a lot of sales in the first quarter, like you pointed out. This year, you expect it to be more back-ended because you've given us a target of 12,500 crores for the year. And the first quarter, you've done just about 2,500 crores. So the remainder of this year has to be, doing almost 3,300 crores per quarter for you to meet that guidance. So wanted to know whether that is happening. And secondly, on collections as well. While your sales have seen a decline, even the collections are lower by about 26%. You stand by your 6,000 crore collection targets for this year?
So on both the aspects, this year we have a sustained set of launches. So the best case scenario even for us is that there's not a lumpy quarter which we see during this year, and sales happen through the course of the balance 3 quarters. And that's our anticipation because there are quite a few planned launches. Like within this quarter, we are doing 1 or 2 large launches on the Dwarka Expressway micro market. As far as collections are concerned, this is in line with budgets. In terms of collections, we'll see a good spike towards end of Q2 and Q3 because some milestones of a few large projects are getting achieved around that time, and hence collections will not be as equally distributed through the year. But around Q3, we anticipate it to be a fairly good quarter in terms of collections. So the number is in line with budgets, business as usual, new projects seeing good uptake, new business development happening, and collections in line with budgets.
Are you sure about this being business as usual? And I ask this largely because from anecdotal evidence that we have and a lot of chatter that we get on social media, I'm not sure how credible that is, which is why the question to you speaks about affordability issues, especially in the region that you're operating in. A lot of them also speaking about something as direct as artificial inflation of prices and creating this sort of, mirage that these houses are selling off like hotcakes because they're selling it to agents, etc. Just wanted to understand what your assessment of the situation in NCR is right now. Are prices anywhere closer to bubble territory? Is underlying demand under pressure?
Prices have spiked over the last 2 to 3 years, and that's why this conversation comes up very often, even on one-on-one basis. But if you really look at the prices over the span of last decade, you will not see them really spiking beyond a particular limit. Our per square foot realizations up just because we've launched a project which is at the most premium location of ours, and that's why you've seen a spike. Over the course of the year, this number per square foot realization is about to go down. So I don't think on an average prices are going up beyond 7 to 8% in any of these micro markets. So, this per square foot realization will come down. Now, with the kind of land prices and with the kind of commodity prices and the kind of product being offered, I don't think, price of, let's say, 13 to 14,000 rupees per square foot basis is something which is, obscenely priced or absolutely unaffordable. I think any given market across the country, these are the baseline sort of numbers which exist as of today.
Okay. Rajat, let's also talk about your overall expansion that you're doing and what that will mean for the balance sheet. Because in the past, you've told us that you plan on becoming net debt-free by FY27. So just run us through, the cash flow position, how you'll be reducing this debt as you go ahead with the expansions.
So see, the net debt position is still almost static. We are at less than 900 odd crores, about 880 odd crores of net debt. 890 crores of net debt exists on the books at the end of this quarter. So that number per se doesn't seem very high to us. And in general, we are not we were never rather very highly leveraged. I would say that, as collections pick up, it's in normal course, this net debt number will come down. So there is nothing additional or very special effort which needs to be, made in terms of reducing this net debt. I would also like to add on that most of the land position which we have, in all of these key micro markets, which is, let's say, between recently launched and yet to be launched projects in close vicinity of 40 million square foot and, upwards of 55 or 1,000 crores of, GDV value. This land is mostly owned by the company, with less than 5% belonging to, the landowners with whom we may have done collaboration shares. And it is paid for. So see, there is no, sort of hidden or, liability which is there. So there is net debt, which is 890 crores. There is nothing particularly due on the land side. So the land ownership belongs to us, so as this converts into sales and collections, it's all going to trickle down to cash for the company. And hence we feel very comfortable not just bringing down net debt, but even the gross debt number, significantly over the coming 2 to 3 years.
All right. Nuvama says that you'll be net debt free by FY27. So wonder whether that's doable or not. But, on the launch pipeline itself, you said that it is sustainable. You have this timeline. Could you give us a sense on a quarterly basis, what exactly does this mean in terms of GDV being launched in this year? And what do you have in the pipeline for the next one?
So see, for the year, we've taken a target of about 17,000 crores of launches. In the first quarter, we've launched about 1.7 million, which is close to 3,500 odd crores. Again, reiterating that, let's say the launch we've done, the land is fully owned by us. And hence, it's not just a sale, which is getting created. It's going to create cash, net cash for the company. Likewise, in the coming quarter, there is almost close to, you could say, between 3.5 and 4 million square foot getting launched. So again, Q2 is a big quarter in terms of launches. And, likewise, Q3 and Q4 also will see, more launches. So this balance, 13 to 14,000 crores of launches, we are comfortable because we are at very advanced stages of approvals across these projects. And hence, we don't see any possible slippage in terms of the launch pipeline.
Okay. All right. By the way, guys, 10 days back, the PM Awas Yojana, which was meant to boost affordable housing, completed 10 years. This is 25th of June. Of course, the contrast can't be starker.
Yes.
Luxury has done phenomenally well. Affordable, nothing at all. Actually, lenders have told us that there is not enough supply to fund on the affordable side. And I think Signature has told us that earlier as well. Thank you very much for joining us as always. Appreciate you coming on and thanks indeed.